Welcome back to the Global Ledger. I'm Justin. Over the last several episodes, we've been pulling apart a really important idea in finance. I'd say probably one of the most important ideas in finance, and that's risk. Not risk as a number or a spreadsheet, and not risk as a volatility statistic either, but risk as it actually behaves in markets through liquidity, funding, and balance sheets. Today, we're going to confront one of the most widely used and most misleading tools in modern finance, and that is value at risk, or VaR, or VaR. And we're going to ask a simple but uncomfortable question. What if the problem with risk models isn't the math, but the fact that they ignore liquidity? This episode is about why risk doesn't move slowly, why losses cluster, and why once-in-a-century events keep happening. Let's get into it. What is VaR supposed to do? Value at risk, VaR or VaR, is designed to answer one question. What is the maximum loss we expect over a given time horizon with a given level of confidence? For example, we are 99% confident we won't lose more than $10 million in a day. It's elegant, it's quantitative, and it gives managers a clean number. VaR becomes popular because regulators need a standardized risk metric. Banks need to allocate capital. Risk committees needed dashboards. And investors wanted reassurance. But VaR rests on a critical assumption that markets are continuously liquid. And that assumption is really where everything breaks. This hidden assumption is that liquidity is always there. Standard VaR assumes you can enter and exit positions when you want. Prices adjust smoothly. Volatility is stable, correlations are predictable, and funding is available. In other words, VaR assumes the market is there to absorb your risk. But in the real world, liquidity disappears. It spreads gap. Funding dries up, correlations spike, and everyone tries to exit at once. That's not a tail event. That's how markets actually work. So risk is not volatility, it's funding fragility. And here's the key insight, I should say, or the core insight here with this. Risk is not price movement. Risk is the inability to fund positions when prices move. A position isn't dangerous because it moves against you. It's dangerous because you can't roll repo. It's dangerous because margin requirements rise, or collateral haircuts increase, or dealers pull balance sheet capacity. That's when losses become real. This is why two firms holding the same asset can experience completely different outcomes. One survives, one collapses. Same asset, different liquidity access. There's a liquidity feedback loop. Traditional VaR models assume independent price movements, but in reality, losses cluster because liquidity is systemic. And here's the feedback loop, okay? Prices fall, okay, number one. Number two, then volatility rises. Number three, risk models tighten limits. 4, margin calls increase. 5, funding costs rise. 6, forced selling accelerates. Then 7, prices fall further. And that repeats. So risk doesn't rise linearly. It jumps. And when it jumps, VaR doesn't just underestimate risk, it becomes actively misleading, in my opinion. So this is why VaR looks accurate right up until the moment it fails. I think maybe another way to think about this is liquidity-adjusted VaR. This is a different way to think about risk. A liquidity-adjusted view of risk factors from a different place. Instead of asking, how much could the price move? Maybe we should ask, can this position be funded and unwound under stress. Liquidity-adjusted VaR incorporates market depth, bid-ask spreads, repo availability, collateral quality, haircuts, dealer balance sheets, and funding maturity. In this framework, risk increases when liquidity thins, even if prices haven't moved. That's the key difference. So, which brings me to why risk explodes in crises in the first place. In a crisis, everyone tries to move up the hierarchy of money. From risky assets to safe assets to treasuries to reserves to cash. But not everyone can succeed. So liquidity-adjusted risk recognizes that selling pressure is asymmetric. Markets clear through price gaps. And the marginal seller really sets the price. This is why correlations go to 1 and diversification fails and safe assets become scarce. Risk is not about probability. It's about who gets out first. Dealers and balance sheets and the transmission of risk are extremely important when we talk about this. Dealers are the shock absorbers of the system. They intermediate trades. They warehouse risk. They provide liquidity. They smooth price discovery. But dealers are constrained. Okay, they're constrained by capital rules, leverage limits, funding costs, and internal risk models. So when dealer balance sheets contract, market depth vanishes, volatility spikes, and liquidity-adjusted risk explodes. That is why risk is not, say, in the market. Risk lives on balance sheets. And so I think this frame of mind will help us understand why traditional risk models, may be failing. Every major crisis reveals the same pattern. Models say risk is low, leverage builds, liquidity looks abundant, and then boom, suddenly it isn't. VaR fails because it looks backwards. It assumes liquidity. It ignores funding structure, and it treats markets as static. And liquidity-adjusted risk accepts a harder truth. Markets are reflexive, fragile, and dependent on continuous funding. And that's not, being pessimistic here. That's realism. So what does this mean for investors and valuation? From a valuation perspective, this changes a lot. Risk premiums are not compensation for volatility. They are compensation for liquidity risk. When liquidity is abundant, required returns fall. Discount rates compress. Valuations rise. When liquidity is scarce, required returns start to jump. Discount rates spike, and valuations fall. I mean, that's the line. This is the missing bridge between risk management, market microstructure, and valuation theory, I think. And of course, I'm trying to frame this where money meets finance somewhere in the middle there. But I think if we look at it this way, I think it reduces a little bit of fear because markets feel terrifying when risk starts to look random. But seeing why losses cluster or why models fail or so on and so forth, the fear starts to lift. And risk isn't chaos, it's structure. And structure can absolutely be understood. I want to thank you for listening to episode 47 of the Global Ledger. We reframed risk a little bit, not as volatility, but as liquidity under stress. In the next episode, we'll push this further. In episode 48, we're going to talk about the valuation cycle, what liquidity cycles really do. We'll show you how liquidity expansions and contractions shape entire market eras, booms, bubbles, crashes, and even recoveries. Once again, I'm Justin, and thanks for being here.